Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you are enjoying this show and getting some great value for your investing goals, well, let us hear about it. Leave us some honest feedback with a rating and review. It helps us, but it also helps other listeners find this show for their own investing goals. If you are looking to make that transition from full-time employee to full-time investor, you're going to need to leverage other people's skills as well as systems and processes to help you scale and grow. Today, we speak to Jonathan Nichols, who is the founder of Apogee Capital. Now, Jonathan has learned how to do that himself, going from being an aerospace engineer to a multifamily syndicator. He shares some of his key insights and steps along the way, and even a couple of things that you want to know to avoid some of the pitfalls that many investors make. If you want to learn more about how you can go from W-2 employee to a full-time real estate investor, you don't want to miss today's episode of Multifamily Insights. Let's welcome to the show, Jonathan Nichols.
Hey, John, I'm excited to be here. Thanks for having me.
Yeah, absolutely. It's great to have you on the show. I went over your bio and background at a very, very high level. Take 2 minutes and fill in some of those gaps.
Yeah, I think the only things that I would add is, I always thought that I wanted to be an entrepreneur growing up. Like I kind of had the bug, but I also had a lot of interest in aerospace, hence my career in that. And while I was working as an aerospace engineer, I never really lost that desire to be an entrepreneur, but I never really knew where I was going to go with it. So, it's extremely difficult to start a business in the aerospace industry unless you're, like an Elon Musk, which I am not. But I think that when I started to learn about real estate and see the value and that there was a blueprint for success, that really clicked with me, having that engineer systems kind of mindset. So my wife and I started investing first for a couple of years on our own in the single family, as you mentioned. We then jumped into multifamily. We've now sponsored, I believe, 8 large multifamily projects in addition to our single family. And we're full-time investors focusing on Texas and Oklahoma. So we've done a little bit of everything from acquisitions to capital raise to asset management. We do it all, and happy to dive into any one or all of those to bring some value to your listeners today.
Yeah, man, I appreciate you sharing a little bit more on that background, right? So had that interest in being into aerospace as well as being an engineer, and specifically going into entrepreneurship, but just trying to figure out where those would converge down the line. Start off as an aerospace engineer and realize, hey, I've still got this passion. I've still got this love for being an entrepreneur. Let me figure out how to do that. Started off with some smaller investments, and then you've basically been able to scale that and grow into Apogee Capital. Let's talk about that transition period. What sparked you to go from, what I presume was a fine and solid career as an aerospace engineer to say, you know what, I really want to take this investing thing to another level.
Yeah, I think there's kind of a couple things that go into it. One, I have to give a lot of credit to my wonderful wife, Paula. She's always believed, I think, in us, and as a couple, working on this business together, and also in myself. And so, she really pushed me to drive it forward and make it, I think, what it is today. Because when we started in single family, we really just thought it was going to be kind of a side gig. Like we're going to buy some houses, rent them out. And, rather than just putting additional funds in the stock market, we would buy some real estate to go with it. But after it started to take off, we realized, hey, we actually have something that could be a viable business here. And that's when we went in full in on multifamily. I think one of the big things for me is I really started to feel some restlessness in my career the last few years. I love the aerospace industry. Like I think anything related to flight, anything related to technical stuff, engineering is super interesting to me. I still read a lot about it, and would never totally weed out going back and maybe doing some kind of contract work or project just because I enjoy it, right? But the part that I got tired of was the corporate side of it. It was the red tape and kind of this artificial ceiling on how quickly and how far that you could climb. And so the thing that really appealed to me about being an entrepreneur was this ability that, you can go as far as your intellect and your work ethic will take you. And so I felt like real estate was where I really saw the opportunity, the numbers, the analysis, the risk assessment piece of this business all really jived well with what I had taken from my aerospace career. And so it was really kind of an unsettled feeling that I would say almost kind of pushed me out and, allowed me to step out of my comfort zone and go be a full-time entrepreneur.
Jonathan, your experience definitely is hitting the spot with me. That was how I felt about advertising. I enjoyed what I was doing, loved advertising. For years, I kept up on trends and the latest news, and still would find myself going to industry websites even after I left the advertising industry. But it was the corporate situation for me. It was just dealing with trying to climb the corporate ladder, having to make lateral moves to go vertical. It just didn't make sense to me. And playing that corporate game, that was one of the things that really sparked and pushed me. And I'm sure a lot of people can relate. And that's the thing that's so appealing about real estate. Real estate is one of those things where you don't have to play the corporate games. You find a good deal, you can put together the capital to do it. You take it down, great. Like it's numbers, right? I mean, either you can drive profits and returns or you can't. But it's not based on your relationships or I'm cool with this guy or I'm this person's person. And I know that just started to crush me. And sounds like the same thing started to happen to you. So you started investing with the intention of really just building something to you and your wife on the side. That started to take off and it looked like a viable business. At what point did you decide to make that full transition to say, you know what, this is what we're going to do? I'm going to walk away from being an engineer.
Yeah, it's funny. I like to use a aerospace analogy, no surprise. And so you think about like you're at an airport, right? You're getting on a flight and you're going to take off. And so you get out on the runway, they put the throttle forward, and there's a point on the runway that the pilots have, which is basically like a point of no return, where even if something goes wrong on the plane, they have to take off because they're just moving so quickly, they'll run out of runway. And so I kind of felt like that's how it was for me. We had closed our first two large real estate deals. One of them was a pretty major rehab, and then the third one was under contract, and we were raising funds for it. And so it got to a point where it just wasn't sustainable, right? I was just, working every waking hour possible, even having to use sick or vacation time to kind of supplement the extra time I needed. And that's when I realized, hey, I've got to make a change. Like this is the time to pull back. And really, that's what I encourage a lot of people to do. I know the whole burn the bridges thing is really popular and it sounds cool or bold, but I think it can also be maybe a bit foolish if you do it wrong. And so if you have a W-2 job that's good and it's supporting you, I would recommend, run with it as far as you can. But then when you get to that point where something is going to suffer, whether it's the W-2 or the real estate career and you need that extra time, that's a good indicator that, hey, it's time to take off, so to speak.
Yeah, two things stand out to me. One, you had some traction in the core business, right? So you had done two deals, third deal under contract. That was the thing where you realized, okay, we have some proof of concept here. It's not me listening to this episode and going and putting in my 2 weeks notice, right? You went out, you executed, you learned what worked, what didn't work, what you needed to adjust. And on that third attempt or that third deal, that's when you decided to go ahead and cut the cord. The second thing you mentioned was making sure that you build up, from your W-2 job and do so until one is going to suffer. And I also think sometimes people leave and then they don't know what to do because they really haven't built up the business to the point where they fully are replacing that time and they know exactly how the time could be better utilized. And this is really important, right? Because the goal is not just to quit your job. If you're leaving, you want to leave because that time can be better utilized to create more value, to create more revenue, to create more dollars. If you're just quitting to quit, sure, but why not continue to work and collect that paycheck until the business is in a position where it really needs you full time? So just something to consider. I know a lot of people try to figure out, when should I leave, at what point. Sometimes it's not about numbers. Sometimes it's not about a certain amount of income. Sometimes it's really about, what are you going to do with the extra time? Because if you're just going to sleep in late and sleep on the couch and do all that, you're probably doing a disservice to your business. And maybe you shouldn't be in business, quite frankly. Maybe you should be a passive investor or something else where you're not required to show up and put in that kind of work every day. And I think people just need to be honest with themselves and their goals, because it sounds sexy to say, hey, I want to invest in real estate to quit my W-2. But as you know, and I know, The truth is you're kind of switching one job for another, but one you have a lot more control over the outcome, the hours, and the key details. But what do you say to folks when they ask you about, leaving that corporate job and making that transition?
Yeah, I think there's kind of two thoughts I have. One is, having a sort of a board of advisors, an advisory panel,
Mm.
a group of mentors. That's definitely useful, and not just a mentor like, oh, join an education program, although that could be a piece of it. But for me, obviously, I had a built-in one with my wife. She knew our situation very well and was able to say, hey, this makes sense. She also continued with her W-2 job about another year and a half before she then quit. And so for us, that made sense. But, I had people outside, partners and, legit mentors and stuff that also kind of guided us on that decision making. So that's one piece. The other thing, if I was to do it over again, it's funny because initially you're trying to just fill your time with activities for the business, right? You try to find stuff and then you get really busy and you have a bunch of stuff to do. A lot of my business growth activity today is figuring out how to hire out and delegate stuff. And so if any of your listeners maybe have read the book, Buy Back Your Time, phenomenal read. That's a lot of how you continue to leverage as you go on in business is utilizing other people's time and experience in order to move your business forward. And, most people would say, well, that makes sense intuitively. But I think I could have better implemented strategies like that, maybe even before leaving my job initially, that would have allowed me to accomplish more things and with maybe keeping the W-2 longer or just having a better quality of life even.
Jonathan, on that note, the concept of leveraging other people, hiring employees, virtual assistants, that makes a ton of sense for people. The challenge for many folks is they're not generating enough revenue to justify it or to feel confident in making that investment at that time. How do you get comfortable with it, or how do you decide when it's right to make that hire, especially if the revenue is not in to cover that person's full salary for a year at that point?
Yeah, that's a good question. So I would say I have a couple thoughts on that. First of all, today I have a full time VA that works for me as like an executive assistant, and so I did not hire her until I had income to pay, right? But you can hire people to help you virtually on a project by project basis, perhaps. So, for example, say you're building a website. You don't have to be a master of WordPress or Wix or whatever you're using to build the website. You can go pay someone a few $100s to do that, and it's a one-time expense. And so that's one thing I would recommend people look at is maybe they don't want to hire someone ongoing, but they want to hire them for project specific tasks that are just not as good a use of their time where they have to go figure out basically website building from scratch as one example. The other thing, and I think this is interesting, is I really see this business as three businesses rolled up in one. You have acquisitions, which is finding deals, underwriting deals, putting business plans, partnerships together. You have capital raising, which is finding equity for these deals. And then you have asset management, which is running the deals and executing the business plan after closing. My advice would be most people don't try to chase all three and maybe not even two at once. Pick one avenue and really go in full throttle because then your time, one, you'll probably pick the one that you're best at. And then your time will really magnify as opposed to like being average at all three, where you don't really get any traction financially, where you can make some money. So that'd be a couple of things. Hire someone project by project basis and really focus your time and attention on the one of those three businesses that's going to give you the most return for your time.
Great tips there, right? One, make sure you understand and drive some revenue where you can. You don't have to make that full salary investment. You can do it project by project to save yourself some time. But then also make sure that you're utilizing your time in the most effective and efficient way possible, not trying to chase and do everything by yourself, but leveraging the skill set that you are best suited to grow with so that you can get some more traction in the business. Jonathan, let's talk a little bit now. You are in Oklahoma today, but you're based in Dallas. I know you're out touring a property. So if our listeners are hearing a little background noise, he's out on set, took some time to do this record for us while he's traveling and checking out some properties, which is always a challenge, right? So talk to us about the business itself, going out there, scouting for deals, getting them under contract, managing these assets. How are you structured today? And what have you learned over the last, 5 or 6 years to help you really grow and scale your portfolio?
Yeah, so I'm pretty blessed again. Like I've kind of already alluded to, my wife and I are both full time. And so, my swim lane is more the acquisition side of things. Her swim lane is more the asset management. We both capital raise and we have partners that also help us to raise capital. But we intertwine, right? And so today I'm up here, visiting brokers and touring a deal. And while I'm up here, I'm doing an asset management visit for her as we're doing a roof replacement on one of our properties that, I want to lay eyes on because it's a pretty large capex project that we're doing right now. I think probably a few tips would be, one, I already mentioned the buy back your time book. If your listeners pick that up, it's been pretty hard on my reading study list lately. The idea of like blocking out time ahead of saying, hey, I have blocked time for these different things, and really using your schedule wisely is extremely important to be successful. Maybe don't go so far as to do podcasts in a coffee shop with background music. So I have to apologize for that. But just using your time well and trying to stack things together is really helpful. Um, I think beyond that, I think beyond that, just understanding kind of the 80-20 rule. A lot of new entrepreneurs will do tasks just to stay busy instead of the tasks that are really going to move the needle, right? And that's something that I personally have to be really careful about. So, it's easy to be like, well, I'm going to do this. Like, I'm going to go look at 30 deals this week. And that may actually be what you need to do. But is it possible that, 15 of those deals are not even within your buy box and you're wasting your time, but you just feel by, hey, looking at more deals, I'm accomplishing something. So I would say use your schedule wisely, really think about what tasks move the needle, and that'll help you, get the most for the time that you invest in your business.
You talked about, both you and your wife full time in the business, knowing what your tasks are. You focus more on the acquisition side and getting clearer on which deals fit your buy box, being able to analyze those deals and not just doing, busy work, right? Essentially, when you are looking to buy, what kind of deals are you looking for? What's your deal criteria today?
Yeah, so we've traditionally been, 100-ish unit type of buyers. Our smallest properties 75 and our largest is 170, but most of them are kind of that 100 to 120 range. So I would call that, mid-size multifamily, B and C assets in markets within both Texas and Oklahoma. So, Dallas, we own a property in Lubbock, College Station, Abilene, OKC, Tulsa. So a number of different really good markets. And for the past several years, my perception of the Dallas market is that it's been too heated. I looked at a lot of deals there, but I haven't found anything that I really like as far as like large syndication type projects. And so we focused a lot on tertiary markets, hence why I'm hanging out in Oklahoma City today. And those markets have done really well for us. As far as like what we're looking at now this year, there's probably two major changes. And that is one, I do feel like we're at an inflection point within the Dallas market. We've seen some decrease in rents over the last 1 to 2 years and an increase in vacancy, partially due to interest rates and mostly due to a lot of supply coming online in that market. And I think we're about at an inflection point where we're going to begin to see that move the other direction, where rents will start going up again and vacancy will compress. And so in my mind, this is a great time to get into the Dallas market. And so we're looking very heavily there this year for acquisitions, whereas previously we were not. So I think that's one big thing. The cool thing is all these tertiary markets that we've been in, while Dallas has taken a hit on rent growth and vacancy, they've been doing great. So Oklahoma City, we saw, I think, almost 4% rent growth last year. Our College Station assets saw almost 4% rent growth. And even some of the softer markets like Lubbock still have a couple percent positive rent growth at the moment. So, no regrets on buying any of those deals. But I think now is a great time to get into Dallas. So a little bit of change on the market. And then probably the other thing, which many buyers are of this opinion now, is a little bit more focus on the B class as opposed to the C, mostly for capex and physical reasons. when you go from like a 70s asset, you really write off a lot of the risks. You may have cast iron sewer lines. You're more likely to have flat roofs. You're more likely to have outdated electrical. You're more likely to have, old breaker panels. Um, Perhaps you have a chiller system as opposed to individual HVACs, although we've always bought, individual HVAC properties. And when you make that 10-year jump up to the 80s, it really makes a large difference on the physical condition of the property. And so that's one thing that we're really kind of pivoting on now is kind of, hey, we as a company have paid our dues buying the C class assets. We really want to be in that B class space now. Now, whether or not we find something that the price works and all that is TBD, but that's where our vision is for this year.
Yeah, I like what you said there, right? You talked about the markets first and foremost, being in DFW, recognizing over the last couple of years, it was difficult to find deals that fit your criteria. So you focus more on kind of OKC and Lubbock and some of the surrounding locations. And those areas have seen pretty good rent growth, whereas DFW has seen some challenges there. That's starting to turn around. But then you talked about the switch from C-class assets and maybe moving up a little bit to B-class assets, primarily due to CapEx. And I think that's one of the things that people tend to overlook. When you look at these numbers in a spreadsheet, these older buildings, they tend to need more work. I mean, when you're talking about 70s, you're talking 50-year-old and up properties. So a lot of stuff can go wrong on these older properties. And if you don't have the proper budget to address these issues, you could get caught with way more than you anticipated. So it's really important just to understand that, analyze that accordingly. And you are seeing more and more investors recognize that, hey, you know what? It's a 10-year difference, but those 10 years are critical. So they are looking to move up a little bit more to the B class kind of assets. You talked a little bit more about kind of where you're headed now, focusing on DFW more, seeing opportunities that start to present themselves. Are you looking to invest and stay kind of that 100-unit kind of range? And if so, are you working with third-party management to manage your assets, or is this something where you're looking to get more integrated?
Yeah, those are all great questions. One very quick tangent that I might just add because it could be useful for your listeners. If you're newer to the multifamily space and you're looking to be active, you still may consider looking at some C assets. A lot of them, they've had the most cap rate expansion, which means there's the most distress within that particular range right now. And so, whereas just to give DFW, for example, C class assets were trading at a 4.5 cap going back 3 years ago. Now they're trading at least a 6, probably 6.5 cap. It's a great time to go buy something if the numbers work, if you bring enough funds to do whatever capex is needed, and if you have a good management strategy. So just something I would throw out there to not totally have your listeners write that off, especially if you're newer. This is a time where it could be a little easier to get in those kinds of assets. So that's one tangent. As far as for us on the unit count size, it really comes down to equity right now. A lot of investors are very skittish. And so myself and many of our partners, our capital raise is probably 30% of what it was going back 3 years ago. And we're pretty blessed that all of our active deals are actually doing pretty well. Like we don't have any major distress deals. We don't have any capital calls or foreclosures or anything like that, which is a huge blessing. But there's a lot of people that, they watch the news every day. They see the bad news and the interest rates and the economy, and they're really concerned, especially your more novice passive investors. And so, it's more difficult to raise capital. And so rather than try to shoot for the stars, we've said, hey, we're going to do projects that make sense, but we know that we can get them done. Now, I will tell you, we bought our largest property last year, 170 unit deal in Lubbock, which we were able to acquire just because the basis is so much lower there than what it is in a lot of other markets. And I really like the strategy running that property. You can support basically 1.5 to 2 maintenance guys. And you can have a full-time property manager and a full-time leasing agent on the property, that's a first for us. All our other properties, have one manager and one maintenance person. And so anytime that you get in a pinch, it gets really tough because you don't have a team. You have one person doing everything, either in the office or outside. So I really do like that structure, and want to move that scale eventually. But we're not going to do so in a foolish manner. So that kind of is the answer to the unit size question. As far as vertically integrated, we would love to do so. We kind of have a hodgepodge of markets that we're in. A couple of them, we have a really good property management company that helps us. And some of the rest of them, they're kind of B level, and we have to do a lot of their work for them, quite frankly, to make sure our properties perform the way we want them to. And so I think long term, that's something we would like to do, but we probably need a little bit more scale within DFW to launch that just to make sense of it numbers wise.
No, I appreciate it. That makes a lot of sense. And I love your clarification on C-class assets. I mean, listen, where there's challenges, there's opportunities. And if you're newer, if less groups like Jonathan's, if Apogee is moving away from that stuff, that means that's one less bid, one less group that's taking the numbers up, and you could probably get some better returns and get in at a great basis. So it's just, you got to have the right plan. The only point here is, don't go into it foolishly. Make sure you understand what you're getting yourself into. Great tips, and I appreciate you sharing more about, Uscale managing those third-party management companies, because again, I think a lot of times, particularly with newer investors, they just assume you hire a property management company and they take care of it from there. The truth of the matter is you really do need to stay involved from an asset management standpoint, no matter who you hire, and you will see who really has great systems or processes for follow-up. You may get a great on-site manager. You may get a great regional manager, but I've got deals with the same company. One is crushing it and killing it. And another one is really struggling. We've actually had to fire that property management company, but I have two different regional managers. One regional manager and on-site team killing it, different regional manager, same company, just dropping the ball on a lot of key things. So it kind of depends. It's definitely a people business. You have to understand that and stay on top of everything there. Jonathan, for folks that want to learn more, they can check out your website, apogeemfc.com. That's APOGEEMFC.com. They can learn more about you and your opportunities there. Right now, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the Mastermind button today. All right, give me a failure or an apparent failure that sets you up for later success.
That's a great question. Probably one of the first house flips that we did, it was kind of a live and flip situation. We bought it during COVID or early part of COVID, and way underestimated what we needed in order to renovate the property. And so we wound up doing a lot of the work ourselves. We weren't able to hire out as much of it as what we should have or would have liked to. And it was a lot of stress, a lot of headache. Fortunately, the single family market did extremely well in DFW from basically going all the way to 2022. And so we were able to sell that year and make a pretty substantial, return on it. But it was definitely a lesson learned that you want to budget in to pay people to do stuff that you don't want to do, or otherwise you don't really have a good opportunity.
I love it. Great lesson, great insight learned there. Give me a digital or mobile resource you recommend for our listeners.
Oh, wow. Digital or mobile resource. If you're a passive investor, we have a masterclass on the website that John mentioned, and it's all about kind of the details of analyzing investments from a passive investor's perspective. So that could be a good fit if you're a passive investor listening to this. If you're an active investor, I would say obviously podcasts like this are really incredible. If you have the desire to really go full time, joining some kind of mentorship, I know that's not like a mobile thing necessarily for the question, but I really think you need someone to kind of hold your hand when you start this industry. There's a lot of risk if you don't know what you're doing, and so. But as far as electronic, I love podcasts. I've listened to several on my drive this morning.
I love it. Give me the book you've recommended or gifted the most in the last year.
And I'll stick with the same theme, the Buy Back Your Time book. even if you're a passive investor and you have no intention of actively investing in real estate, you work in the corporate world, phenomenal book about how to be more productive, use your time wisely, get the most of your time, and live a more fulfilled life. I would highly, highly recommend it for literally anyone.
What's the daily habit that helps you stay focused on your goals?
Yeah, I've been a endurance athlete for a lot of years, so I do a lot of running, a lot of like triathlon type stuff. Not as much, competitively the last couple of years, but every morning I get up and I do my workout. I do it early in the morning before anyone can interrupt me or anything's going on, and I always just feel better, right? Like even if it's a day where I don't feel as good or I don't have much time, just doing something, getting active, and I think just the practice of, particularly if you can kind of push yourself and get uncomfortable, it really helps the rest of the challenges of the day to go a lot more smoothly, I think.
Give me your number one insight for scaling in multifamily.
Yeah, I think I'll revert back to something I said earlier. And I would say it's really understanding this is three businesses and thinking about your strengths and what you enjoy doing and which of those three businesses are the best for you. There's nothing wrong, especially if you have a partner you're working with, to try to tackle more than one. But if you're by yourself and you're starting out, focus on one, focus on capital raise, focus on acquisitions, focus on the asset management, and just get really, really good at that rather than spreading yourself thin across all three.
Great tips there. Jonathan, let's go in a different direction. You are based in Dallas. Give us your favorite place to grab a bite to eat.
Oh, wow. There's this hole in the wall restaurant right down the street from us that we discovered during COVID because you could do takeout there when everything was shut down. It's called Tandoor. It's an Indian restaurant. And I had actually never eaten Indian food up until this time. I probably visit it minimum once a month, maybe even more. Like, I like it that much. It's a really great place. And so it's in the middle of DFW, like between Dallas and Fort Worth, but a great hole in the wall to stop at if you like Indian food. And even if you don't, you may like this because like I said, I had never had it before.
Sounds like a great option there. Well, Jonathan, you gave us some great information, man, talking about kind of your journey from being an aerospace engineer to starting to invest on the side with your own portfolio, realizing that you can actually turn this into a business. And that's exactly what you did. Ended up launching Apogee Capital, 8 multifamily deals, 1 self-storage deal, and talking about what it takes to scale, going from, doing everything yourself with you and your wife to starting to bring on team members to really understanding how to scale and what you do well. I think one of the biggest takeaways for me is leaning into your area of expertise, right? For you, it's acquisitions. It's making sure you've got the right people in place. And you mentioned that book a couple of times, right? So we'll make sure we link to all of that in our show notes, because if you can buy back your time, that makes your life a little bit easier. And I think ultimately, for many of us, we look at entrepreneurship. Yes, we want to work hard and work for ourselves, but ultimately we want to create a lifestyle where we have the flexibility and the freedom to do the things that we want to do with the people we want to be with at those times. So I appreciate you sharing more on that, Jonathan. Again, for folks that want to learn more, they can check out ApogeeMFC.com and check out that guide and masterclass you have on investing as an LP investor. Jonathan, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.